Investment can appear to be simple, that buy low and sell high is all that's required. What if I told you that's not the case? Anyone who has tried their hand at investing would tell you that it's difficult because most individuals are unaware of what to do. According to research, index funds and ETF are mainly familiar to those older in age. So, if you're younger, you should make an effort to learn more about this right away. Now, if you want to make good financial decisions for the future, you need to know a lot about the different investment options out there. Index funds, exchange-traded funds ETF, and real estate investment trusts, REITs, are three examples that can benefit your retirement account and really fulfill your overall FIRE goals. FIRE is the acronym that stands for Financial Independence Retire Early. In today's video, we will talk about all of these three funds. What is the difference between them? And last, we will discuss which one is best for you. So don't miss any portion of the video. Also, if you are new to the channel, don't forget to subscribe and hit the bell icon so you won't miss any future videos we upload. Without wasting any more time, let's get started with what these three funds are. Index funds are mutual funds that track a certain index, such as the S&P 500 or the NASDAQ 100. When you invest in an index fund, your money is used to invest in all of the firms that comprise the index, giving you a more diverse portfolio than if you bought individual equities. Consider the S&P 500 as an example. The S&P 500 is a prominent index that tracks the performance of the 500 largest corporations in the United States. Investing in an S&P 500 fund means that your money is tied to the performance of a wide group of firms. Moving forward, an exchange-traded fund, the ETF, is a pooled investment asset that functions similarly to a mutual fund. ETF often track a specific index, sector, commodity, or other asset. But unlike mutual funds, ETF can be bought and sold on a stock exchange in the same way that conventional stocks can. An ETF can be designed to track anything from a single commodity's price to a huge and diverse group of commodities. ETF can even be designed to follow certain investment strategies. The SPDR S&P 500 ET, SPY, which tracks the S&P 500 index, was the first ETF and is still an actively traded ETF today. As for REITs, Congress established REITs, or real estate investment trusts, in 1960 to provide all people with the opportunity to profit from investing in income-producing real estate. By purchasing stock, REITs enable anyone to own or finance properties in the same way that they invest in other industries, by purchasing stock. In the same way that shareholders benefit from owning stock in other firms, REIT stockholders gain a piece of the revenue generated by real estate investment without having to go out and buy or finance property. Now that you guys know about all three funds, next, let's consider why you might want to choose or avoid each of these types of investments if you're retired. The primary distinction between index funds and exchange-traded funds ETF is that index funds can only be traded at the end of the trading day, whereas ETF can be traded throughout the day. ETF may also have lower investment minimums and be less tax efficient than most index funds. Even though they are different, index funds and ETF have a lot in common, such as diversification, low costs, and good long-term returns. ETF and REITs both provide investors with the opportunity to earn healthy returns, but the main difference between the two is how the funds are managed. ETF passively monitor the performance of an index or subset of the market and are not given hands-on treatment by a financial professional or corporation to maximize return on investment. As a result, ETF are typically inexpensive for investors. REITs, on the other hand, are profitable because they are managed by a group of people who acquire, sell, and develop real estate. As a result, REITs tend to produce larger returns, and they are required by law to distribute 90% or more of their taxable revenue to their shareholders. However, REITs can carry more risks. As long as ETF and REITs are incorporated into a coherent overall portfolio strategy, retirees can benefit from one of these two types of investments, or perhaps both of them. It is important for retirees to have a solid understanding of the costs and risks connected with any particular REIT or ETF that they are contemplating investing in, as well as the expected level of income and the manner in which that income will be taxed. According to experts, retirees should be looking for dependable investments that create a stable yield or income for them during the years in which they are enjoying their retirement. That objective can be met by using both REITs and certain exchange-traded funds. From an expense ratio standpoint, both ETF and index funds may be quite inexpensive to hold. You can easily find funds that cost less than 5% of your investment every year. Trading commissions are another expense to consider. If the broker charges a commission for trades, you'll pay a set cost every time you buy or sell an ETF, which could reduce your returns if you trade frequently. However, some index funds have transaction fees when you purchase or sell them, so compare expenses before deciding. When compared to most actively managed mutual funds, index funds and ETF are both low-cost solutions. To choose between ETF and index funds, assess each fund's expense ratio first and foremost, as this is a continuous fee you'll pay for the duration of your investment. It's also a good idea to look into the commissions you'll have to pay to acquire or sell the investment, but these fees are normally less essential unless you buy and sell frequently. Over time, broad-based ETF and index funds that are managed passively have done better than actively managed mutual funds. An elite minority of active managers may produce outstanding outcomes over shorter time periods by selecting specific stocks, but it is extremely difficult for them to maintain a winning record across decades. So what does this signify for your index fund or ETF investment? The S&P 500 has averaged yearly returns of around 10% over the long run. You won't get that number every year. Some years it will be greater, some years it will be lower, but it's enough to double your money every 7.2 years or so on average. To sum up the whole discussion, the choice of ETF versus index fund versus REITs is probably less important than the fact that you decided to invest for your long-term goals using a passive investing vehicle. Each one of them has its own pros and cons. If you choose an index or ETF, you'll benefit from lower fees, diversification, and historically superior performance of index-based investing. On the other hand, REITs are more profitable but also carry high risks. So now you guys have an idea of which investment fund is suitable for you. Well, that was all for today's video. Please keep in mind that the opinions offered in this video are not investment advice. They're intended for educational purposes only. Every investment and every transaction contains risk, so you should always undertake research before making a choice. If you enjoyed the video, please share your thoughts in the comment section. And if you're new to the channel, don't forget to subscribe. Thank you so much for taking the time to watch this video.